All right, here we go. Hopefully, everybody had a wonderful Halloween and got to see lots of little urchins and hand out candy, or went to a good costume party, or whatever the case may be. I sat home and handed out candy and watched a good World Series at the same time, and enjoyable evening. Yeah, except my wife and son and I had spent Wednesday evening carving out pumpkins into really nice jack-o'-lanterns, and as my wife was gone for the evening, it was my duty to put those jack-o'-lanterns out on the porch so all the urchins could see them and light them up, etc. And obviously I forgot, and so my wife was gone, and so I was just in a little bit of trouble. But it's not the first time that I've been in trouble. I know you find that probably hard to believe, but it really, and yeah. Anyhow, I won't go there. So onward. Well, round 3 hit, and at least we have something better than an unwinner. We did have some positive numbers on there for profit, some positive net income. So that's kind of a relief, I guess, and hopefully you guys some of you end up catching up to the computer run team and destroying it before the end of the semester. I think you will. So anyhow, we have let's look at last week's assignment first, kind of go over that. So round 2, the assignment was why did all the student teams have a very low contribution margin? Two things. Again, contribution margin is prices, variable cost. And we probably could have, and if you did, that's fine. I honestly didn't bother, but you could look at the various levels of labor and material costs and come to some conclusions maybe about the variable cost. But, at first, again, it's prices, variable costs. So I looked at the prices in every segment compared to Ferris, which had the highest contribution margin. The student teams had lower prices. So every segment, all the teams, all the student teams, all the products, they were all lower priced than Ferris, which had the highest contribution margin. So that's the main reason. Again, if you spent a little extra time and you delved into some of the variable cost issues, that's maybe fine, but the main reason was certainly this. 2, why didn't Andrew's traditional product, Able, sell very well? And the same question for Erie's traditional product, Eat. So Able, the biggest reason was lack of marketing. Let's go take a look for Able down here in the traditional segment. Here we are, traditional segment. Able, you got to come down the list pretty far. It had 8% of the market. Its performance and its size coordinates weren't horrible. Okay, kind of right in there with most of the other teams. Its price, a little higher, but Ferris had a higher price even and sold a bit more. MTBF, it's possible. No, it wouldn't have been MTBF because it was up within the 1/3. Age, its is sitting pretty good, good with respect to the other teams, but relatively low marketing. Look at that, $500 for promo, or $500,000, I think that would be, and sales budget of just $100,000. Okay, so here you had a product that really, wasn't positioned that poorly, had a lot of stuff going for it reasonably well, but they didn't spend much on marketing. Now, maybe they saved some money. Probably saved $250,000 to $750,000 versus some of the other teams that still sold. Well, okay, so it could be a conscious decision. Don't know. And then, although the price was higher than the other teams except Ferris, and so price might have had a little bit to do with it, But again, Ferris sold more, even though it had a higher price. So I think price would have been a factor, but maybe not a huge factor. Why did and the same question for Erie's traditional product, Eat? Well, Eat was simply too whole. Come down here, 2.6 is that 2.61 years. You know, it was just getting a little long in the tooth there, I think is probably one of the biggest problems there. It had reasonable amount spent there. I don't think that its performance and size coordinates were too far off, but a little long in that. Its price was fine, but a little long in the tooth, and so that would be my guess for EAT, and it's not a guess. But okay, 3. Including inventory on hand for all teams, what's the total potential number of units in the traditional segment that could be available for sale next round? Assume that all teams produce at full capacity. And what I really wanted you to look at here was the fact that we had a lot of inventory. Oops, I went to the wrong sheet, although I'm going to come back to that one. You know, if you went down here, I mean, 2,500, 35, 36, 42, 50, whatever, right? So there was a ton of inventory left over in the traditional segment. And, as I come up here and as I often say, we got all kinds of capacity. Now, I don't know for sure that it exists in the traditional segment, but I can figure that out, right? And what I did, so, I highlighted all of this. I'm starting down here. Oops, let's get that % sign in there. So I highlighted all this. I right-clicked and hit copy. I pasted it into a worksheet here. I had to expand a column, I think, here for the date. But it gave me this, and just to show you a couple little tricks, it made it a little bit easier then to do the math here, and I'll try to make this a little bit bigger. Okay, it's a little hard to see when it's that big, but it's all right. It's hard to see everything, I'm sorry. We can kind of take a look, though. We start up here with this one, Abel's traditional, 2,500 in inventory, roughly, just short of 2,500. And they've got a capacity to build 2,000. That's a first shift capacity. So they could build 4,000 units. But here, what I did, I just used a simple if statement, and I'll demonstrate that for you. Okay. If's under, if I come up here and I go, it's under logical. So I find logical there. I click on an if statement and I click OK. And it brings this up and it says, and I can't make this any bigger, I don't think, I'm sorry, but it says logical tests. So it's if, and what I want to say is that, okay, if this is traditional, so if this cell, and I'll click on that cell, and I'll hit equals, and I got to use quotation marks here, but I put trad for traditional because that's how they've got it there in the game. Okay, then the value, if true, I want it to enter in. I want it to be that amount of inventory. I want to figure out what my inventory is. And the value, if false, is 0 or nothing. And so I'm just going to put a quote and a space and then another quote, and that'll just be a nothing. Okay. So in this case, it is true, and so it gives me that, right? Now, I can just drag that down, right? Because that's going to pick up all of these that say traditional. We've got 4 of them here in the Chesters, okay? And it'll give me what their inventories are into this column, right? So I can just grab this, make the little cross with the black thing, and drag her on down. Okay, to right there, I want to include all of those. Okay, boom. And then I just want to get a sum of those, and so, I already have, but I'll just do it. Okay, I want to come up and again catch all of these. Right to there, enter. So 7,202 is what I have on hand, or what you guys have on hand is inventory. Okay, well, I can do the same statement over here. Now I want to look at your capacity, and so again I just used the same if statement, if, and I went back and I had that if that D8 or this column equals traditional. Okay, then I want to enter in, if that's true, I want to enter in my capacity, which is that one, and the value, if true, is going to be that, and the value if false in it is, again, I put the space in between the 2 quotation marks, and that would give me 0 or nothing like I see here. Okay, so just a little trick. You guys don't have to do this, but you can use your calculator and come up with the same thing. Okay, and then I can sum those. Remember, this is just first shift capacity. So my first shift capacity is 11,600. If I multiply that by 2, I come up with, of course, 23,200. And I add that to my 7202, and this is what I come up with here. 30,402, which would be 30 million, I'm sorry. 30,402,000 units that could potentially be available next round. So huge, right? What's my demand for next round going to be? Well, it was 8,600 this round. I got an 11% growth, so it's going to grow about 900,000. So I'm going to be about 95, 96 maybe, next round. So yeah, we would have the ability to make more than 3 times what's needed, okay, for next round if all the teams made the capacity, which of course they won't, right? We have nearly enough in inventory to meet the demand. Okay, we're only a couple thousand short of that. And I did it 7202, 11.6 first shift capacity, so total capacity. There you go. Okay, 4 got kind of long, so I'll probably give it a little more weight when I grade this. But why wasn't Baldwin very efficient with its SG&A spending? We know it spent quite a bit without generating real good sales, so be more specific with your answer. Well, and I probably got a little bit wordy here, but in the low and traditional segments, it really didn't spend that much. And in the performance segment, it was not out of line. And I think in the size segment, that's true. Now, in the high end, it did spend more than any other team, and yet sales were poor due to a badly placed, relatively old, low MTBF product. So they had a product that was not in good position, right? Didn't meet hardly any of the buying criteria, yet they spent a lot of marketing on it. Didn't do so well. Okay, but the thing is when I look at all of its marketing, it only comes up to about 9 million, and they spent 15 plus million in SG&A. So where'd the other 6 million spent? Well, if we look at SG&A, when we look at the income statement up here, SG&A is R&D, promo, sales, and administration. And you guys would know by looking at your administrative costs on your income statement, or not your income statements, yeah, would be income statements, I'm sorry, that they're relatively low. Okay, and so R&D would then be the next biggest. So they spent a boatload of money, did Baldwin, okay, there they are, on R&D. Well, what happened? Let's come down and look at their products. Ooh, well, look at those dates. We were all in 17. Your guys' revision dates were all in 17. So Baldwin spent a lot of money to push out some products, okay, into future years, okay. I'll tell you now, and Baldwin's probably figured this out, that's not money well spent. Okay, when you go out more years like that, then you don't get to revise it the next year, and your customers tend to kind of hang on because they already know that you've got a revision in place, right, for 2 years from now. So why buy this product when I'll wait and get the new one when it comes out? So. Okay, so that was a bit of a problem, and that was probably one of the biggest reasons that they had a big ton of money spent in SG&A, and it didn't really help them out too much. So there you go for 2. And honestly, I'm sorry, I hadn't looked at your assignments for 2 yet to see how they looked or anything. So, but let's jump in then and take a look at round 3, see what happened. I'll probably spend a little less time, hopefully, going through this now that we're getting along in the semester. You guys should have a pretty good idea. When we're done, we'll take a look at the winter spreadsheet and the assignment for the week. So coming along, right? Okay, we had some ROE, some big negative ones, and then 4 positives, so that's good. So we had some positives, so at least we know that 4 of the student-run teams made some money. And when we look at sales again, pretty nice. Big fight between Erie and Chester. Digby, not terribly far behind. Excuse me, I had to sneeze. And EBIT then, Chester again, pretty decent. Look at that, Chester's EBIT is bigger than Erie's, even though they had less sales. Well, interesting, and it's really interesting when you consider that they had a smaller contribution margin, which would usually be the first thing that I would look at. It's always the first thing I look at. Their contribution margin was almost 5% less, but what offsets that? Well, the thing that offsets it, like I've always said, is that their SG&A to sales about 7.5% better. Okay, okay, because it was less there. So you want this one to be small, you want this one to be big, okay, and they had a relatively small one there, even though it wasn't real big in the contribution margin, but that allowed them to have a bigger EBIT, even though their sales weren't quite as big. And they had bigger profits, about $3 million compared to $7 million. So as a result of that, and some other things, right? There's about a not quite $2.6 million difference there, and there's about a $4 million difference there. So they had some other things that contributed to their profit, and we'd see that in the income statement, right? Our stock price is kind of going a little zigzag. The computer team, pretty much straight up. I'm hoping that you guys don't let me down. I think every semester when we get finally to the competitive rounds, by the end of the competitive rounds, generally the student teams have caught up to and have managed to surpass the computer team, because student teams learn. The computer just kind of plays it the same way. So cash flow statements, we got... You had, nice increase in cash flow for Andrews because they got rid of some inventory. But remember, they had a tremendous amount of inventory, and likewise Chester got rid of some inventory, whereas Digby, Erie, and Baldwin all had some increases in inventory. Okay, plant improvements. Baldwin, it looks like spent a little bit of money. Andrews has done the opposite, right? Chester, nothing. A little bit of money by Digby. Erie's spending quite a bit again, and Erie's been spending a decent amount in plant improvements, so we might want to know why. Dividends, Erie also paid a little bit of a dividend. Purchase of common stock, Erie bought back some common stock. That's a little bit unusual for the way you guys have been playing. Cash, we see some cash on hand, not too much there. Andrews and Chester actually have a decent amount of cash on hand. And in Andrews' case, it was because of getting rid of their inventory, right? So they did a nice job of getting rid of some inventory, accumulating some cash that maybe they can do some things with then going into the future. Total equity, look at that. We got two companies down here that are really kind of tiny. Go small, and you can go small and do well, okay, depending. Now, they've also got really, really low sales, and so it'll be interesting to see how they handle those things. So variable costs, we don't really concern ourselves with too much. Depreciation, Erie's got quite a bit, Baldwin next because of improvements, right? SG&A, Erie again spent a lot of money on SG&A, and their expense we saw up here, 14.4, so higher than everybody but Baldwin, but theirs is based on 14.4% of those sales there, so huge, right? And we can look at see what they spent, whether it's in marketing or, again, for them it might be in R&D. Other fees, write-offs, we don't pay too much attention to the EBIT, which we saw up above, and then we also see an interest. Baldwin and Andrews, of course, a tremendous amount, probably from some debt. Baldwin, I think, had a huge emergency loan, right? So that was big. Taxes, boom, earnings, which we saw up above. Ferris still beaten. Okay, again, we come down to capacity versus production. Still all kinds of excess capacity, and again, you see teams Ferris, Erie, and Chester. The teams that had the biggest profits are at least trying to use some of that capacity. Ferris certainly is, and they're winning. Apparently, they've maybe figured out that keeping unused plant around, or plant and production capacity and whatnot, isn't necessarily the best idea, but. One thing that jumped out on me here, and this was kind of interesting, I got down to Team Erie, and they sold the most. That jumped out at me first for in the low end. I probably saw it down below and then came back up. And I remembered that they had invested a lot last round in their automation, which didn't show up last round, right? And so this round, then I kind of wanted to take a look, and look at that. They sold a ton. Their price is by far the lowest, Okay, Manchester was the next 75 cents, but a lot of the other teams were still 20, 21 bucks, so $3, $4 probably less than the normal. And yet, look at that contribution margin. You will see if you scroll up and down, Erie had the biggest contribution margin in spite of the lowest price. Well, what happened? Well, it looks like their investment in automation, and as we'll see below too, they've made some investments in HR. They're really driving their labor costs down in particular. Now, their material cost is similar, but their labor cost way down, and thus gaining a huge advantage there in terms of variable costs and promoting a good contribution margin. So, and they've invested some other in some of their other segments too in terms of automation. And remember, they had a decent amount of plant. They have also introduced some new products through the rounds, and they've spent a lot of money on that. So a lot of money invested there. We'll see over time how well those might pay off. Chester's dominating the traditional segment, but that's maybe to be expected. They actually have four products that are kind of, I don't know, they have it circled, right? And so that's probably a big reason why they're kind of dominating that with four products selling there. Each product's not huge, 8%, 10%, 11%, and 14%, but boy, you add all that together, yeah, and you get over 40% of the market. Erie had more potential, so they could have sold more, so they kind of gave some up there. Might have put them over the top, who knows. Big low-end segment, Erie dominated that. And again, remember, had also a high contribution margin and dominated it because of low price. Gave up potential, right? They could have sold another 5%. Ferris, and that's probably one of your questions for this, gave up a lot. Okay, and Andrews and Baldwin and Digby all kind of took advantage. As we get down here to the high end, far different than the practice rounds, right? Although we're seeing some similarities because we're seeing, some of these teams like Chester kind of vacating, Adam and Bid and some of those, they're kind of hanging around. We see Ferris still dominating. Of course, they got two products, and again, they're right out here towards the front edge. Erie has two products too, but not nearly as well positioned, and difficult at this point to move those up to be competitive without doing what Baldwin did and getting that revision date out too far. But three teams there. Dixie's in pretty good place, so three teams there really competing for the high end, and I think we'll see that continue. Yeah, we'll see. In the performance segment, here Erie dominates, and they do have the two products there, which Ferris only has one product, and that's why Erie's kind of dominating a little bit there. Digby's hanging around too, and not too bad a position. Foam, though, is by far the biggest, although Edge did well, sold almost as many, had a little lower price and a few other things, but pretty competitive here in the size segment. But again, Ferris, Erie, this goes right on down. You guys can look at all those. Again, actual versus potential. Use these numbers with the assignment that you're going to have today. Okay. The perceptual map, I probably get a pretty good feel for what each team is doing at this point in time. I should have a pretty good feel, anyhow, for what each team is doing at this point in time. We see at the HR, really only Team Erie investing a lot there. And go back and remember, how low their labor cost was, and the contribution of both automation and this, right, would have contributed. Far and away, 7% better than most teams, and 5% better than even the next closest in terms of that, and their total, their total labor costs probably, what the heck? I'm going to screen back up here. Sorry. Its total labor cost probably somewhere's in the neighborhood of $50 or $60 million. So you save an extra 5%, or you save $2.5–3 million. Okay, and again, that's savings that will not only continue, but it will grow throughout the rest of the game. TQM starts next round, so make sure you're aware of your TQM that you need to spit out for next round. So that's kind of it. We'll take a look at the assignment first, maybe. Assignment for round 3. How much excess capacity will there be next round in the performance segments? So again, I want you to kind of take a look. I'm not asking for, don't consider the what's in inventory. Just tell me what the capacity is, right? Okay, and in the performance, here we go. I'm not sure what kind of inventory there might have been, but take a look at the teams and what they would be able to make in the performance segment next time, and just tell me how that compares to what the demand's going to be. So you're going to have to calculate what the growth is, right? So the growth, 30, you had 3.3 million. That's going to grow at a little less than 20%. So it's going to grow by 600,000 units or better. Okay, and then you need to come up and calculate for me what the total capacity is, both shifts, right? And tell me then how much is excess. How much did Ferris miss out on in the low end? So here I want unit sales, and I've added another twist. I want you to tell me in the profits. So again, here's the low end, and so we see that they had a potential here, and they, actual here. So they gave up, 6 or 7% in the low end. But you need to come down and use the numbers down here, right? Ferris, low end, right? It's this one. Okay, it's feet product, right? What's this? The actual market share was 11.1, and they kind of get offset here a little bit, and they could have had 20.1, but you also need to, their fast product here sold a little bit better, right, than it should have in the low end. Okay, so you got to do some calculating there on those. That's going to be a reasonably good and detailed calculation. Okay. So you can figure out what the units are pretty easily, what it missed out in terms of its total. That's going to be pretty simple. That's just its total potential versus that, times the unit demand. But then you have to also figure out what its sales were, and you got to keep in mind then that each of these products, because they had 2 products apparently selling in the low end, both fast and feet. Fast, I think, is normally a traditional, but probably starting to sell some in the low end. Okay, and so you've got to then figure out what their sales could have been, right? And this one's going to be a negative, actually. In other words, they sold a little bit more of fast than what they should have expected. So it's going to deduct from here, where it's 9% difference. Okay, and then the profit. Ooh, and then the profit. Go up and use its labor and material costs, okay? And we can assume that each of these products that it didn't sell would have had those costs, whatever the labor and material ended up being at the end of the year. So that's what its cost would have been per unit, right? And that would be before tax, and I should put that in there. Maybe in the future I'll have you do after tax. There we go. Make that change. Okay, question 3. Ferris invested about $28 million in plant improvements. What is the immediate effect on profit? Okay, this can be shown in numbers, but numbers are not absolutely required. Be sure to fully explain your reasoning. And I've talked about this oftentimes, and in general I've said that when we spend cash and we put in equipment, okay, or plant improvements, it's kind of a trade of one asset for another. Okay, there are some differences, and I want you to just really kind of point out what those differences might be, or things that can be affected, in terms of making that kind of an investment, and how it might affect the profit. But I also want you to realize when you get done that the effect may be quite a bit smaller than what you think. In other words, the $28 million sure as heck is not an expense. And then 4, what would Ferris's ROE have been if it had a cash position of exactly 0 at the end of the year? Okay. For example, if it paid out all its cash in dividends. So once again, we've done this one in the past, so this one shouldn't be any kind of a surprise. You probably go back and look at some of the things that I've submitted and get the how to do it from that. So shouldn't be terribly difficult. All right. So who won this round? Yeah, let's go take a look. Yeah, okay, get through all the mumbo jumbo and all the stuff. Okay, here we go. Well, Ferris, followed by Chester on earnings per share, likewise in ROE. Contribution margin, Ferris, followed by Erie. Erie had a nice contribution margin. Then stock price, Chester had the nicest jump in stock price, and followed by Erie. Okay, and profits. Oh, Ferris followed by Chester and Erie again. Cash flow, actually the best cash flow was Andrews. Again, converted all that inventory, or a bunch of inventory anyhow. I think they still have a bunch, but better than they were. And strategy, no changes there. We did have deductions for a lot of teams except Chester and Ferris. So Team Ferris, our computer team, came out on top, but Team Chester came out on top in terms of our student team. So congratulations to Team Chester. You guys get an A for the round and don't have to do the assignment. Lucky you. So that's all I have for this week. A little bit quicker. I'm hoping that you guys are appreciating that. And if you have questions, give me a holler. I should say, too, I'll be sending out the CompXM access codes. I'll try to go down and get those today, maybe yet, while this is uploading. And I'll be sending those out in the next day or two, the access codes, so that you guys could get in and start on the CompXM. When I send them out, I'll try to send a little more information. So thanks and have a good day.